Saira, let me start with you. Was it really all about the CPI numbers in the end for this week?
Well, the Santa Claus rally has come early this year for three reasons. One of those is inflation, which is coming in under expectations. Also, the Fed has signaled the end of the rate hike cycle. And finally, the economy, which is showing some signs of cooling, but not enough to take us into a recession. All of this caused 10-year Treasury yields to drop by about 50 basis points and markets to rally. However, I caution 2024 looks a little bit more complicated. The question is going to move not from how high will interest rates go, but to how long will interest rates stay high. And given that futures markets are expecting 4 rate cuts in 2024, I think that's optimistic because inflation is still above target and we're not in a recession. So I don't see why the Fed would be cutting rates so aggressively going into next year.
So, Peter, before we get to 2024, which we do want to get to, what about for the rest of this year? Can we put our pencils down on our desks? Are we in pretty good shape for the rest of this year, do you think?
You know, in this business, a week can be a long time. Just look at the move from 2 Fridays ago to this Friday. So no, and you can never put your pencils down. And if you listen to some of the Fed talk, President Collins, they're kind of like, wait a second, financial conditions aren't really that tight. If you look at the equity markets, we may have to raise again. So I agree with Saira. I mean, I'm in the camp that I don't even think the Fed is going to cut at all next year, and that's going to make for a bumpy road. And depending on what the news conference is after the next Fed meeting, this could sort of be an upside down. Remember, in 2018, you had the tremendous rally the last week of the year. This could be the opposite of that.
Oh, really? So the reverse of a Santa Claus rally?
Well, you have a, you know, if you pick any low in the fourth quarter, by definition, you're going to have a rally off of it. So, yeah, she said we had an early Santa Claus rally. We had a low, we rallied. But then we could have a nice little correction going into the end of the year.
So, Saira, how much of it do you think is in the hands of the Fed? We all focus on the Fed. It's understandable what we do. But it's not just the Fed that determines things like yields, for example. We've got a lot of issuance coming out of the Treasury these days. It looks like that's not going to stop anytime soon.
I think it is still very important. And what is the Fed going to do next year? Let's start with inflation, which Peter talked about, which will have to do with whether we get rate cuts. Inflation is still about 1% above the Fed's target when it comes to CPI. And that last mile of inflation could be the longest mile. Our view is that inflation likely doesn't hit target in 2024. That's going to prevent you from getting aggressive rate cuts. So that's going to be an issue for the Fed. And also looking at the economy, the consumer and employment markets have been driving the economy. Payrolls are still coming in close to 200,000. Yes, we did see unemployment claims spike to August levels this week. So employment is starting to slow. Consumers starting to show some cracks when it comes to delinquencies. But none of that means a recession is imminent. Until you get those two factors of inflation at or below target and a recession right in front of us, I don't think the Fed's going to have the room to cut rates.
But what about the equity side, Saira? Because we've had sort of I can say a subdued earnings session here. What are we looking for in 2024?
Well, Q3 marked the end of our earnings recession. Before Q3, we had 3 quarters of negative earnings. So it was good to see this growth in third quarter. And in 2024, we expect about 5% earnings growth. That'll be positive. It will be dependent on companies' ability to preserve margins as inflation continues to moderate. So that'll be the positive. I don't think we're going to see a lot of valuation expansion driving the markets in 2024 because valuations are already at a premium.
So, Peter, what about the consumer? Because the consumer really feeds directly into earnings because companies have to sell things. Where is the consumer right now? Are they running out of all that excess savings that they had?
Well, first of all, Saira made a great point. But when I look at the consumer, I kind of try to watch, Visa and MasterCard as a proxy for consumer. And those stocks have continued to stay strong, close to their all-time highs. So I think it's a little premature given the fact that employment is still high, right? Unemployment is low. Again, another indication that financial conditions are not tight, and therefore, I think the higher probability of rates going up. So the consumer's in pretty good shape for now, but I look at the 3 C's, right? Copper, corn, and crude. And they have been weak, so that's saying something about the aggregate demand in the economy. So that's the irony of markets. They have been weak. That drags down inflation, but is that bullish?
Saira,
Peter brings up a good point, David, about the consumer. They continue to spend and consumer discretionary stocks have been very strong this year. But if you look behind under the hood at the consumer, auto and credit card delinquencies are increasing significantly. I think the consumer is starting to show some cracks. And if the employment markets continue to slow and people do not feel secure in their jobs, I think that'll be the unwinding of the economy that does eventually get us into that recession. But again, as I said, that is not right around the corner.
Sarah, you usually like to pick a stock or two for us. Do you have a stock or two to recommend?
We do. So we're looking at, first of all, we think the dollar's going to be, it's at peak levels and going to weaken from here. So outside of the US, countries where there could be demand, and also commodities, which tend to benefit from a weaker dollar. Peter mentioned copper. That's an area that we like. Supply is tight for copper. Freeport-McMoRan is a company specifically. They're finishing their last smelter in Indonesia in early 2024. So CapEx is declining, and they are returning cash to shareholders. Demand for copper is strong. Not only has U.S. production of copper declined significantly over the last half century, but also wind, solar, electric vehicles, and increased need for U.S. infrastructure as we onshore. All of that will increase demand for copper, multi-year tailwinds for that commodity.
Peter, is it too soon to get back in the pool for real estate?
Well, there was a very interesting article on Bloomberg today about how so many homeowners actually don't have a mortgage. So this notion that, well, the market's frozen because people don't want to sell because they have low mortgages, that may not be true. If that's the case and people want to trade their stock, that may increase the housing supply, and that could drive down some prices again. Ironically, is that bullish or bearish for interest rates as housing demand gets met with increased supply? So is it too soon? No, but it's going to be interesting.
Fascinating. What about?
I think an area, David, within REITs that looks really attractive is actually the public REIT sector. It's trading at a discount to net asset value. REITs actually tend to underperform while rates are going up, and in periods of rate pauses and rate cuts, REITs outperform. And I think that's what we're getting to. This elongated pause by the Fed should be positive for segments such as REITs.
Well, Sarah, that's fascinating. I mean, REITs got clobbered, obviously. Do you think they bottomed? They're going to come back up?
We've actually seen them bottom in the last couple of weeks as yields rolled over. And if you look at history, as the Fed pauses, and we don't expect any more Fed rate hikes, that should be positive for REITs. They're still cheap. They're trading at a discount to NAV. Many are worried about commercial real estate, but if you look at the main REIT benchmarks, it is a very insignificant low single-digit percentage portion of their benchmarks. Industrial REITs, apartment REITs, all of those are actually doing very well. So it's not just a commercial real estate story. That's a very small piece of REITs.